Hello and welcome to this edition of Money's Best Friend with me, Vivek Law. Stock markets continue to remain volatile, but there is no need to worry. One way to get around this uncertainty in the stock markets is to diversify your portfolio. In this episode of Money's Best Friend, we will tell you how to diversify your portfolio and how to invest properly. Joining me now is one of India's finest money managers, Nilesh Shah, Managing Director at Kotak Mutual Fund. Thank you very much, Nilesh. It's always a pleasure talking to you. These have been difficult times, isn't it? In fact, over the now past several weeks, we've seen enormous amount of volatility, and that is making investors feel rather concerned whether they did the right thing by investing in the stock markets through mutual funds, because we did see a lot of inflows in the last 1 year. Can you explain in the most simple way that you normally do what really is going on, and is there a reason for investors to be worried?
So the concern is for the traders, not for the investors. Traders who took 3 months, 6 month, 1 year view or even intraday view, they have lost money. But for investors now, it's an opportunity to buy equity shares at 15 or 20% cheaper than what they were available some time back. So my feeling is that investors should not worry. Traders should definitely worry as to, in this volatility, how will they be able to survive and make money. Why have our markets corrected? Partly it is driven by global factors. So last year, a lot of money in our markets came from FII, which were primarily exchange traded funds. These were the funds in which retail investors subscribed, and they took a bet on emerging market. Now, these retail investors all over the world are seeing the headlines. Brazil is in recession. Russia has market cap which is less than Apple's market cap. China is slowing down. There are corruption scandals in Malaysia. Indonesia, reformist president is not able to deliver. So all these media headlines about emerging market have turned distinctly negative, and that's creating doubt in the minds of retail investors should they continue with their exchange traded funds. A lot of emerging market exchange traded funds are seeing redemption, and then they are putting redemptions without looking at prices across emerging market, including India. Their redemption is redemption of a passive money, not an active money. The second factor which has impacted our market is selling by sovereign funds, which were primarily dependent upon natural resources like oil. So all those oil producing nations now, as the oil price is corrected, need to liquidate their investment to support domestic economy. So their exit from India is again need of their local economy rather than view on India. So keeping these two things in mind, we believe today the selling pressure is driven by passive money. Selling pressure is driven by compulsive money, not by an active money. And over a period of time, there will be bottoming out of FII selling as certain long only money will understand our fundamentals. They will differentiate India vis-a-vis other emerging markets, and that's where we will see gradual recovery in our market.
Nilesh, we saw what many people call a hope rally, an expectation rally over the last 18 odd months, ever since Prime Minister now, Mr. Modi, announced his candidature to be the Prime Minister of this country. We saw very significant gains in the stock market. At the end of the day, stock markets are about the performance of the underlying companies, isn't it? On that front, we haven't really heard good news. We've been hearing for the last 1 year that the worst is over and corporate earnings will get better. That doesn't seem to have happened. So do you believe that we are still some time away by when we'll see a decisive upswing in our markets?
Sure. So definitely we have underestimated the earnings recovery. The actual earnings have been much slower than what we had anticipated. But as they say, there is always hope for a better day. We certainly believe that over next 6 quarters, somewhere from here till March 2017, there will be confluence of factors which will improve corporate earnings. The first driver will be interest rate reduction. A 1% reduction in borrowing cost for borrowers will translate into about 7% earnings growth. The policy rates have been down by 75 basis points, but the cost of borrowing for the real borrowers haven't come down correspondingly. We believe going forward there are more cuts in policy rates, and RBI will transfer or transmit this borrowing cost to the consumers, and hence there will be earnings recovery in corporate sector by virtue of interest rate reduction. The second benefit will come from the government spending. Today private sector investment is on the back foot, and we expect government to spend money and put the investment revival on the front foot. In FY 2015, government had saved about $50 billion from lower oil prices in terms of subsidy reduction, but that was used for clearing the fiscal deficit. So we brought our fiscal deficit under control. In FY 2016, that $50 billion will be spent in road, railway, transport and other infrastructure development. April to July 2015 have witnessed 90,000 crore more spending on a year-on-year basis. Now, consequential beneficial impact of this spending will translate into better demand in economy and better corporate earnings over a period of time. The third factor which will come again supportive for India is the rupee depreciation. Whole of FY 2015 rupee appreciated against yen, euro and GBP, and that severely impacted our exports growth. For last 6 months our exports are negative. In FY 2016 we believe rupee will find its own level. It is still stronger vis-a-vis many currencies, but definitely it's weaker compared to FY 2015. This will give some helping hand, some breathing space to the exporters. So the exports which have lagged economy, that will also start recovering, albeit on a very, very slow pace. The fourth benefit which is going to come is the pay revision for the central government, state government and public sector enterprise employees. The 7th Pay Commission recommendation should get implemented somewhere towards 2016, more probably in second half of 2016. Now this is going to put money in the hands of large number of government employees, exceeding probably more than 3 million people. Now that spending power will again support urban consumption, automobile, housing. So this combination of events, one, interest rate reduction, second, exports recovery, third, government spending rejuvenating economy, and urban consumption getting supported by the Pay Commission wage recommendation. All these things is creating good platform for higher growth and better corporate earnings over next 6 quarters. And we believe corporate earnings will recover, albeit gradually, albeit little back-ended, as we move towards discounting March 2017.
So what I hear you say, Nilesh, is that over the next 6 quarters, once corporate earnings bounce back and the economy gets better than what it is today, we will see certainly a stock market which is much better than what it is today.
Definitely. There is one more factor which gives us longer term bullishness on stock market. If we see the retail investors, they have been consistent seller of equities for last 20 years. Today their holding is less than 8% of current market capitalization. Now they have realized that what they have sold, equities, have delivered far better return compared to where they have put their money, like gold, real estate and fixed deposits. So there is a tectonic shift happening in the savings pattern of individuals, where instead of investing in physical assets like gold and real estate, they have started shifting their allocation towards financial assets, which includes bank deposits, which have started giving real rate of return, and equity mutual funds. There are more than 80 lakh investors which do systematic investment plan in equity funds, and they bring probably somewhere between 25,000 to 30,000 crore a year into equity mutual funds. So we are seeing this pattern shift among the savings pattern of individual investors, And that gives us confidence that one, fundamentally our markets are on the recovery path. From a flow point of view, now we are seeing more domestic participation. And as soon as the FII selling kind of subsides and kind of slows down, we will see bounce back in the equity market. One interesting point is that in whole of calendar year 2008, what FII sold, which resulted into Sensex coming down from 21,000 level to 8,000 level, more than that has been sold by FIIs in calendar year 2015. And despite that, markets have just corrected from 30,000 to 26,000. And that small correction is courtesy strong support provided by domestic investors. Imagine if the FIIs, which starts differentiating India versus rest of the emerging market, become a net buyer, will probably have to worry about where will the supply come from.
All right, there is Poonam, who's 25 years old. She's from Asansol. She's joining us on the line. Hi, Poonam.
Hello, sir. Good morning.
Good morning. Good talking to you. You're from my hometown.
Yeah, okay. Same here, sir.
Yes, tell me, what have you been doing? You're a student.
I'm a student, sir. I'm 25 years old and I'm from Asansol.
Right.
So, want to invest in mutual funds, sir. So, I can save 2,000 rupees monthly. So, suggest me what are the options to invest in for mutual funds.
All right, great. Nilesh, a very good question, and it's very nice to see you were making earlier the point about how a lot of investors are increasingly doing SIPs, and of course, we've not even scratched the surface yet, but it's good to see 25-year-olds coming out and saying, I want to start small. And in fact, that's the other point you may want to make, that it's not necessary that you need to have a lot of money before you start investing in a mutual fund. 2,000 would be a perfect amount to start with at that age, isn't it?
Absolutely. And it's very, very heartening to hear that a young student who wants to make investment. Poonam, you have actually implemented the first golden rule of investment, that always start early. When you start investing at 25 years of age, the kind of head start you have over someone who's starting to invest at 35 or 45 years of age is tremendous. Second, when you're investing in longer term horizon, because your income as you move to 30s and 35s and 40s will be much higher than what you are earning today. So you can afford to take little extra risk compared to, say, someone much elder to you. So my recommendation will be to do SIP into equity mutual funds. Just keep on doing it irrespective of meager or negative returns for some period of time. Equity markets reward patience and long-term investments. They don't reward short-term trading all the time. Second thing which you must focus upon is that your income is going to go up as you move from student into active working life. At that point of time, don't restrict yourself to 2,000 rupee SIP. Make it 4,000 and 10,000 and 15,000 and 20,000. So you have accepted the first principle of starting early. Now just have the discipline of long-term investment. Increase your allocation whenever you start working. And I'm sure 10-15 years down the line, you will be far more wealthier compared to your other peers who haven't done investment.
All right, Nilesh, thanks as always for coming by and sharing your perspective with our viewers in these interesting times. Thank you very much. All right, it's time to take a quick break here on Money's Best Friend. After the break, Anil Rego, founder and CEO Right Horizons, will join us and we'll discuss more on managing your portfolio. Keep watching. Joining me now is Anil Rego, who's the founder and CEO at Right Horizon. He's a well-known certified financial planner. Thanks very much, Anil, for joining me here on the show. It's been quite tough, isn't it, for investors? I'm sure a lot of your clients have been calling you, wanting to know what to do now with the markets having fallen the way they have. And while we've had some stability, but they still remain volatile, isn't it? What are you telling your clients to do right now?
I believe that volatility is an investor's best friend, and we follow a bit of a contrarian style. And I love volatility because it helps enhance returns. But the point is, are you positioned for that volatility at that point of time? So what investors need to do at this point is go back and relook at their portfolios. And if they have not already booked some profits, you need to first of all see, are you in, let's say, stocks which are momentum stocks which could fall very sharply. I think it's important to enhance the quality of your portfolio. Again, on the overall look at how diversified are you? You've completely into equities, and if so, maybe you need to have some options like, let's say, debt funds or even right now the tax-free bonds, etc., which help counterbalance the volatility. And in summary, I think if one is a disciplined investor, he wouldn't get carried away when markets are high and go and invest at that point. And at the same time, it's very important on the downside, not to panic because markets will take care of themselves. And if you have a systematic style of investing and look at a long term, I think you'll definitely do well.
It's quite interesting, Anil, that you use the word that you love volatility. Can you explain why do you love volatility?
Let me give you an example, of what we did recently. We found that, let's say, mid caps were running a little ahead of, valuations, and so we went back and did a profit booking, including on the mutual funds where there were mid cap funds. And today, that's actually the money which is getting in on a systematic basis, and it will actually enhance now the returns of the portfolio. So we are very happy, and if one is disciplined in that way and see, yes, markets are doing well, our valuations too high when everybody is running after the stocks and the momentum stocks, and mid cap portfolio are doing extremely well, that's the time to actually watch out and see, is this the time for me to de-risk, and vice versa. So right now, one has the cash to be able to deploy it, and actually that will enhance returns.
You talked a little earlier, Anil, about the tax-free bonds that are now hitting the market. Can you tell us a little about that? And as far as the debt side of a portfolio is concerned, do you think it makes sense? Do they fare better according to you as compared to, say, a standard bank FD, which is where most of us end up putting our money in?
Yes, I think tax-free bonds actually make a lot of sense for two reasons. One is that in a declining interest rate scenario, tax-free bonds can actually give you a good capital gain as well. And the second reason is that especially for fixed deposit type of investors, they are tax inefficient avenues, and a tax-free bond will actually almost give you a 10% type of return if you were actually invested in a bank FD, which means if you are in the 30% bracket, that is. So if you got 10% in a bank, after 30% you're only left with 7. So today you're getting more than 10% yield through these tax-free bonds. So it's a definitely a good option to look at, even including investors who are little apprehensive of looking at income funds for their volatility, and they don't mind looking at tax-free bonds. They are also a good option. What is good about the tax-free bonds is, even though they are long-term and they are ideally 10 years plus, they also have a listing, and that gives them liquidity, and you can also sell it even before the due date, and that makes it an interesting option for most investors.
All right, Anil Rego, thank you very much for joining us here on Money's Best Friend. Appreciate you taking your time out. All right, it's time now to wrap up this edition of Money's Best Friend. If you have any query related to equity, mutual funds, insurance, real estate, gold, then do write into us at moneysbestfriend@aajtak.com. Goodbye for now and have a nice weekend.